one big thing that consumers continue to be upset about is prices. And they were very concerned about the fact that prices for groceries and food items are still very elevated.
You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Erik Lundh, Principal U.S. Economist at the Conference Board and guest host of today's episode. In today's conversation, we'll discuss the latest U.S. Consumer Confidence Index, as well as our outlook for the global economy. Joining me today is Dana Peterson, the Chief Economist and Leader of the Economy, Strategy, and Finance Center at the Conference Board. Welcome, Dana.
Hey, Erik, how are you?
I'm great, thanks. So let's dive right into it. We had the May consumer confidence numbers come out this morning. What are the biggest takeaways from the survey?
Sure. After 3 months of declines, we saw a bit of an uptick in the data for May. But I would say that still consumers are having mixed feelings. While they are happy that they're working and they're saying that their incomes are well supported, they do have concerns about the future, both trilaterally in terms of the business outlook, jobs, and also incomes.
What were some of the interesting write-in comments that we saw in the survey?
Sure. So one big thing that consumers continue to be upset about is prices. And they were very concerned about the fact that prices for groceries and food items are still very elevated. We have seen a downtick in concerns about gasoline, but certainly food is present of mind for many consumers. They don't like the fact that eggs are $8 and bread's $12. And so that's something that's really concerning consumers.
What were some of the primary drivers that caused the movements that we saw in the Consumer Confidence Index?
Well, the good news is that both the present situation and the expectations gauge ticked up in the month. We saw in the present situation gauge that consumers were not as optimistic about current business conditions, but they still said that the employment situation is good. And they said that they believe that jobs are easier to get and that it's not the case that jobs are hard to get. So it's really about the labor market story in the present situation. In terms of expectations, all three submeasures, business expectations, income expectations, and employment expectations, were slightly better in the month. But the overall gauge, the expectations gauge, is still below 80. It's been below 80 for some time now. So that suggests that consumers are still wary about what might happen 6 months from now.
What about the reading in terms of age and income? Was there any interesting takeaways from the stratification among demographics?
Yeah, so by age, everyone was somewhat happier in the month. So that's great. We didn't have any splits by generation. But certainly when it came to income, folks who were making more than $100,000 were more optimistic in the month than people who weren't. That's probably always the case. In fact, when we look at the data, it's when people have more income, they just tend to be happier in general. But we did see somewhat of a divergence in terms of people making over $100,000 being a little bit more optimistic relative to the other groups.
Dana, what about recession? Consumers have had some concerns about recession in the past. They've been going down. But what do we see in the May reading?
Sure. Well, we have two pieces of bad news here. Again, as I mentioned, the expectations gauge was below 80. And typically anything below 80 for a persistent period of time suggests that consumers are looking towards a recession. And also, we do ask consumers point blank, do you think there's going to be a recession at some point over the next 12 to 18 months? And that measure ticked higher for a second month. Now, recession is not our forecast, as you know, Erik, and you do our U.S. forecast, but we do anticipate that there will be a soft patch in the U.S. economy. We already saw growth slowing in the first quarter, and you're forecasting that growth is going to be probably sub 1% Q-on-Q annualized over the second and third quarter. So I think consumers are kind of picking up on that, but a lot of it's going to be up to them. Are they going to pull back on consumption? That's something that you've been forecasting for some time, especially given the fact that consumers have run out of their excess savings. They've been buying on borrowed time using credit card debt, and the interest payments on those pieces of debt are rising out of control. So I think consumers may be onto something here, but not recession, but certainly a slowdown.
No, agreed. I mean, in terms of some of the other concerns, how are consumers thinking about the future of inflation, interest rates, and the stock market?
Sure. Well, the inflation expectations gauge ticked up a tad, but it's materially lower than what we saw just even 2 years ago. But the fact that it's moving higher, we think that that's also consistent with concerns that consumers are stating about prices for food, and also the fact that they expect interest rates to be higher. So when we lag the interest rate gauge against the federal funds rate, it does a pretty good job. And so for a while, consumers were saying, yeah, we think interest rates are going to come off. Now they're not so sure. And I think that's because the Fed has been keeping interest rates where they are at the highest point that we've seen in decades, because inflation has been quite stubborn. When it comes to the stock market, consumers are actually really bullish. They think that the stock market is going to continue to climb higher, and that kind of makes sense when you think about what's driving stocks. A lot of it's tech, and a lot of that tech is based upon AI, and there are really high hopes for that. But certainly when it comes to inflation and how long interest rates are going to be higher, consumers definitely have concerns.
And in terms of their feelings about their household finances, which capture things like employment and inflation themes, what are we seeing in those metrics?
Both metrics for the current conditions and expectations for consumer finances ticked downward in the month, but they've been kind of moving back and forth. But I think that consumers, once they really start to worry about employment, it seems like there's some concerns about that, then we might see those measures really start to deteriorate.
So this year we also have some pretty big political events sort of on the horizon with elections in November. Was there anything interesting coming out of the survey in terms of observations about the political environment?
Sure. Over the last few months, concerns about the political environment, which you can fold everything up into, did pop up among all the write-in questions. But we saw a little bit of a pullback in the latest reading. It's not clear why, but it's something that we definitely have to watch, especially since the election is drawing closer and consumers are wondering what's going to happen after that. So while it did pull back a little bit in terms of all of the concerns, it's still out there.
And we also ask consumers about their buying plans or intentions in terms of spending. What did we learn, if anything, about their intentions for buying durable goods?
Yeah, so intentions to buy homes are still very low. And that is consistent with what we're seeing in the housing market. Existing home sales fell again in recent months, and also new home sales, while they're picking up a little bit, they're still the smaller share of the market. And a lot of this reflects two things. Number one, home prices are very elevated. Even though they are not as high as they were during the depths of the pandemic, certainly they're still quite high, and affordability is an issue. And the other reason is because mortgage rates are very high. Mortgage rates reflect what's going on with the federal funds rate. And as long as the Fed indicates that it's not willing to start cutting rates anytime soon, then mortgage rates respond to that, and they remain elevated. And even we did see mortgage rates come off a little bit late last year after the Fed said, we're done raising rates for now. Mortgage rates came off, but as the Fed continues to wait month after month, mortgage rates have picked back up. And so between elevated mortgage rates and the high cost of housing, we've seen that consumers are not very interested in purchasing a home. When it comes to other big ticket items like cars and appliances, oftentimes also need to be financed, we're seeing a little bit of improvement in terms of willingness to purchase a car after a slump. And also appliances are up a little bit. That may be linked to the fact that new home sales are picking up, and when you buy a new home, you have to put in appliances and things like that. But really, many of these measures are still quite weak, and consumers, as we see in the real data and the hard data, have pulled back on durable goods. In fact, in the first quarter, I think durable goods growth was flat or close to being flat. And we think that's probably going to continue over the course of this year, according to your forecast.
No, absolutely, yeah. What about services in terms of intentions? You know, services have really driven the economy in 2023, early 2024 as well. What is the outlook? What are consumers saying about going on vacation and spending on services more broadly?
Yes, in this survey, we didn't have the vacation question, but in recent surveys, we have asked about vacations. We've also asked consumers about what types of services they're planning to buy. And the interesting thing is that they still want to go on vacation. They still have strong intentions to do that. However, once they get to the hotel, it sounds like they're just going to sit in the hotel and hang out there because they're less desiring to go out and engage in out-of-home types of of entertainment. Also, they're moving away from highly discretionary services and they're moving more towards purchasing services that are necessary, like healthcare and car insurance. And we know car insurance prices are, yes, the price of car insurance is still rising very quickly, and it's something that's impeding the Fed's ability to bring down inflation. So consumers are saying, hey, yes, we still want to go on vacation, but we still want to save money on other things because we know that we still have to pay a lot of money for healthcare and car insurance. So there's kind of this reorganization within the wallet, or at least the buying plans of consumers for services.
And then finally, Dana, what does consumer confidence tell us about household spending this year?
Well, I think consumer confidence is telling us that consumers do plan to spend on things like vacations and to a certain extent some durable goods, but they're going to be pulling back. And certainly that's consistent with their concerns about the future, certainly when it comes to their incomes, what business conditions may look like, and most importantly, employment. So I think this is all consistent with the forecast that you've been putting out there, Erik, about a slowdown in activity this year led by the consumer. But this is really all a part of the program. The Fed raised interest rates to cool off demand. And so we saw housing demand slow first, then business investment slow next, and finally we're seeing that last shoe, if you will, which is consumers. But again, we're not anticipating a recession, and your forecasts are for the Fed to start cutting rates most likely in the final 2 months of this year.
Oh, that's right. Given some of the difficulty with inflation we had in Q1, we think it's probably not going to happen until towards the end of the year, unfortunately. We're going to take a short break and be back with more conversation with Dana about the global economy.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge, from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite Perspectives. I'm your host, Erik Lundh, Principal Economist at the Conference Board. I'm joined by Dana Peterson, the Chief Economist and leader of the Economy, Strategy, and Finance Center at the Conference Board. So Dana, we're going to pivot and talk a little bit higher level as opposed to just U.S. consumer confidence, and maybe talk a bit about what's happening with the global economy. So why don't we start off with, what is our outlook for the global economy this year?
Sure, we still have global growth growing right around 3% this year, which is actually pretty good. That's a pretty good rate of growth for the overall economy globally, but it's going to be highly determinant on the region. So we're expecting that Europe is going to recover from last year, where many parts of Europe experienced mild recessions or deep slowdowns on the back of the cost of living crisis as inflation rose due to the ongoing war in Ukraine. The U.S., we think, as we said, is going to see a soft patch this year, but kind of start to get out of it later on this year. So much of the growth is actually going to come from emerging markets, and in particular from Asia. So in China, we expect that growth is going to be around 5%. And that's probably very likely given the tremendous amounts of fiscal stimulus that's being implemented in the economy to offset the weakness that we're seeing in the housing market. And also India is really going to stand out this year. There's been a lot of infrastructure spending. Elections are going on right now. And a big driver of that is because at least the current government expects to be reinstated because they've invested so much in infrastructure and building out the economy. So those are the things that are really going to drive GDP growth over the course of this year.
So you mentioned China and India and a couple of other emerging markets, as well as Europe. Are there any other economies that we should be watching over the course of the next year?
Absolutely. We should continue to watch Latin America and certainly what's going on in the Middle East, as well as Eastern Europe. So in Latin America, it's kind of a mixed story. Many of those economies have already started cutting interest rates, which is great because they vanquished inflation faster, but also they had much higher inflation and more inflation than other economies, and they acted very quickly. So they're coming out of that period of pandemic disruption, high interest rates, and now they're getting back to a point where central banks can help lower interest rates. And that should be healthy for many of these economies and bolster growth. We need to continue to look at the Middle East because there, as we know, there's an ongoing conflict. It seems like every day it's worsening, but it's also spilling over into regional economies. We still have the Red Sea issue where ships are being blocked, and that's causing higher inflation for commodities that are being shipped through the Red Sea. We also know that the fighting that's going on in Gaza is also spilling over into issues between Egypt and Israel. And for Egypt, they're suffering great losses from the Red Sea being clogged. And so we're continuing to watch that. The good news is that many of the economies in the region that do produce oil are not really being negatively affected. Oil prices are still pretty high. And also, some of those economies are much further along in their paths to developing non-oil GDP. And so that's also helping them in terms of avoiding some of the gyrations that we might see in oil prices from the conflict in the Middle East. And then, of course, there's Eastern Europe, where there's the ongoing war, Russia's war in Ukraine. And certainly that's causing massive disruptions in supply chains, especially for food. But the good news is that much of Western Europe has been diversifying away from Russian energy. So that's creating somewhat of a buffer to prevent another surge in inflation that would weigh on the Western European economy.
So you touched on Europe previously in terms of maybe a bit of stronger performance this year. Maybe you could elaborate on a little bit and talk about what was holding it back and what are the tailwinds for Europe over the course of the rest of the year.
Sure. Last year, what was really holding back Europe in general was Germany and also the UK. Both of those economies experienced recessions last year. The UK, some of that was a function of residual issues from Brexit, but also very elevated inflation rates and consequently a surge in interest rate hikes from the Bank of England. And in Germany was heavily hit by two factors. Number one, factories were very negatively impacted by the fact that energy prices surged when Russia cut off natural gas flows to Europe in response to Europe's punishment of Russia for invading Ukraine. And also Germany was very negatively impacted by weak demand in China. Shockingly, well, not shockingly, but I think many people may not understand that there are very strong trading ties between Germany and China. So when one economy is not doing well, the other one also suffers. But we think that both of those issues, or at least certainly for Germany, that's going to turn around. And the thing is that not only are the UK and Germany going to see somewhat better growth this year, we also have very strong growth from some unusual economies like Spain and Portugal. France have been doing very well. And to start off the first quarter of this year, we had very strong growth across the board among most of the major economies throughout Europe. And so we think this is going to set Europe up for a minor rebound this year and certainly better growth than we saw last year.
You also touched a little bit on inflation when we were talking about U.S. consumer confidence. What globally kind of inflation story are we expecting to play out? Is it going to continue to slow?
Yes, absolutely. We are seeing inflation slow over many economies that suffered big spikes. And that's a function of the supply chain disruptions from the pandemic being overcome, energy prices falling, and also consumer demand for goods shifting downward. And then also for a lot of consumer services demand, that also being eroded somewhat by elevated interest rates. So with all that, we do expect central banks to continue to cut interest rates. Emerging market banks, central banks have already started cutting interest rates. We're expecting that both the ECB and also the Bank of England will start cutting interest rates in June, and the US will cut interest rates later on this year. Now, China and Japan really stand out because Japan has been raising rates because inflation has been elevated. Who knew after almost 40 years of super low inflation, Japan's having an inflation problem. So we actually expect interest rates to rise there. But in China, most of last year, they were suffering from deflation and disinflation. So some of the readings have been a little bit better. But the big story for China is not so much monetary policy, it's fiscal policy. As I mentioned earlier, China is still suffering from an acute housing crisis. And that housing crisis has also been weighing on consumer sentiment. So many Chinese consumers lost wealth, and so many of them are engaging in something called precautionary savings. So they're not spending, the housing sector is poor, and also state and local, provincial governments don't necessarily have the money to invest. So a lot of it's falling on the central government, where they've been focused on renewables, building up that manufacturing base. And also they are investing in housing, encouraging banks and also provincial governments to buy up surplus housing and turn it into rental units. And also there are additional injections of cash that the federal government is making to help bolster Chinese growth. So even though the underpinnings of Chinese growth are pretty weak, through the process of all this additional fiscal impulse, we think China probably can see growth in and around 5% this year.
So as central banks cut globally at varying rates, depending on where they're located, this is probably going to serve as a bit of a tailwind for global growth entering 2025, or when are we going to see the benefits of some of those interest rate cuts?
Yeah, so we're already seeing some of those benefits, especially in emerging markets, which have start cutting interest rates first, but also because their inflation declined or slowed back to the target ranges that they desire. And so we're probably going to see a little bit of a kick to the economy late this year and then also next year. But still, not our global growth forecasts are not that different. So it's still really in and around 3%. Maybe we'll see a tenth or two higher next year, but that's still pretty good in terms of a global economy. But a lot of it's still going to be about these regional stories.
Okay, Dana. Well, thank you so much for joining us today.
Absolutely. Thank you.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.